discussion around the set. Joining us as our guest host is Armstrong, the CEO of Armstrong Investment Managers, and also in the studio with us this afternoon is Simon Ballard, Senior Credit Strategist at National Australia Bank. Happy New Year to both of you. Nice to see you in 2013. Anna, let me kick off with you. We've seen a lot of green across the charts today, which is interesting because European markets, as they closed out last year, weren't exactly reacting negatively to the fact that we weren't getting a deal on the fiscal cliff. So why the strong rally today?
One of the biggest worries during the end of the last year was that the US was going to fall off the fiscal cliff. And I think this is a great start of the new year, that clearly the tax concessions have been extended to a huge number of US population. The taxes are increasing only for top 2% of earners. And also the fact that the next stage of the plan will be put in place is something that is really reinforcing the confidence of the markets. Now, clearly, whether this is the fact of pure fiscal austerity that we'll see over the next 2 months, and how much the debt ceiling is going to increase, and whether it will be matched by spending cuts, as Republicans would like, on one basis, that is a challenge that they will have to resolve.
Simon, we've seen some reaction to on credit markets. How relieved are you today that we got to a deal on the fiscal cliff?
I think there's a huge amount of relief. Obviously, we've rallied significantly. The iTraxx themselves about 11 basis points tighter, into around the 106 mark, and it was trading at 119 just before Christmas. It's a question of whether we've come too fast, and whether this is overdone. If you think about it, at the end of the day, yes, they've come to a deal, but in 2 or 3 months' time, February, March, we're going to be talking about the monetary picture overall within the US. So this is no long-term fix. It is an aversion. It's sort of averting the fiscal cliff in the short term. So I think we're probably a little bit overdone in the short term here.
I wonder how much the markets have learned about brinkmanship from the US. So the first time around it was the debt ceiling. We saw the negative reaction as the rating agency stripped the US of the AAA credit rating. This time around, markets were rattled across the board. Does that mean next time round, as they start to negotiate these spending cuts, and that we will actually see less reaction from markets though?
Well, I think it depends how much you get in terms of the sell-off, and we had a little bit of a sell-off towards the end of December. Last year was incredibly strong, but there was a great amount of nervousness towards the end of the year about, as Anna said, falling off the cliff. The fact that that hasn't happened, we've rallied exponentially sort of this afternoon. Yes, I guess there's probably less of a reaction each time that you get some headline and stimulus injections coming in, but for the time being, it's all part of the risk-on, risk-off trade, which I think is going to characterise much of 2013 as it did last year.
This is the question, isn't it, Anna, on balance? Are stock markets more likely to rise in 2013 now, or do you think the same risks remain if we look at the Eurozone activity today that was suitably weak?
It really depends on how they approach the solution of debt ceiling and how much is actually needed. Some numbers are showing to get themselves through midterm elections in 2014. The required amount is $1.5 trillion. And neither side really took into the account spending cuts of that magnitude. And it's highly unlikely they will be able to agree very quickly over the spending cuts over the next 10 years. However, if they do not come with a good plan how to tackle the debt ceiling and spending cuts, and if they approach the problem by small increases in ceiling, markets are going to be nervous, and we're going to see risk on and risk off that will be interchanging.